Hello, everyone, and welcome back to What Changes. I'm your host, May. We are standing on the precipice of a massive shift in the financial markets. For years, we have watched the precious metals markets quietly advance in the background. We have watched the debates about inflation, about the Federal Reserve, and about the long-term devaluation of the US dollar. But recently, something fundamental has changed. The market has entered a phase where price is no longer just ticking up quietly. It is actively forcing capital to reposition. Today, we are going to dive deep into a strategy that goes against almost every instinct you might have as a precious metals investor. We are going to discuss why one of the most legendary resource investors in the world, a man with over 5 decades of experience, has just sold 80% of his physical silver. Yes, you heard that correctly. In the middle of a bull market, he sold the metal. But he didn't leave the sector. He moved that capital into something else, something he believes offers a leverage that physical metal simply cannot provide right now. We are going to break down the math, the psychology, and the specific companies that are poised to outperform in 2026. This is about understanding the difference between insurance and speculation. It is about understanding the difference between price and value. Before we get started, I want to invite you to join our growing community of critical thinkers. We have a Telegram channel where we discuss these changes in real time, sharing charts and data that don't make it into these videos. Please, click the link in the YouTube description and join the Telegram channel today. You don't want to navigate this volatility alone. Now, let's talk about the silver miners that are set to outperform every other asset. To understand where we are going, we first have to understand the current state of the silver market. According to recent market analysis, silver has been surging through historic milestones. We have seen volatility that has taken silver from sub-$30 levels in prior years to explosive new valuations, with some reports noting record highs touching above $121 per ounce before experiencing sharp pullbacks. This volatility is not an accident. It is the result of persistent monetary debasement, expanding sovereign debt, and robust industrial demand from renewables and electronics. The world is waking up to the reality that silver is not just a monetary metal, it is a critical industrial component of the future economy. However, as prices move higher, the conversation has to shift. When an asset class moves from being hated to being loved, the easy money has already been made. Rick Rule, a veteran of natural resource cycles, argues that the most lucrative phase of a metals bull market is not necessarily when the commodity price itself is rising, but when the equity valuations, the mining stocks, fail to adjust to the new pricing realities. This is the crux of the argument we are exploring today. The metal itself commands attention, it grabs the headlines. But beneath the surface, a more consequential dynamic is taking shape. The mining equities are lagging. And when I say lagging, I mean they are priced as if silver is trading at significantly lower levels than it is today. Rick Rule recently made a personal decision that shocked many of his followers. He revealed that he sold 80% of his physical silver. He took that capital and fully ported 80% of it into silver mining stocks. Why would he do this? It comes down to the definition of his portfolio. For Rule, physical gold is insurance. It is a way to maintain liquidity and protect purchasing power. He saves in gold. But silver? For him, silver represented a speculative asset class. He bought it years ago because it was a hate trade. It was despised. Nobody wanted it. And because it was hated, it was cheap. His thesis was simple. When the hate subsided, the price would increase. Guess what? That happened. The hate went away, the price went up. And the reason for holding the trade as a contrarian speculation vanished. Holding silver simply because you remain bullish on monetary debasement becomes inefficient if there are other assets that offer better leverage to that same thesis. Markets reward timing, not loyalty. Let's break down the arithmetic of this leverage, because this is where the real opportunity lies for 2026. When you own physical silver, for you to make money, the price of silver must go up. If silver stays flat, your profit stays flat. But mining equities work differently. Silver equities do not require higher prices to generate improved outcomes. If silver prices merely stabilize at these current high levels, operating margins for the miners expand. If prices rise modestly, earnings can surprise meaningfully, and if prices rise sharply, the repricing of the company's net present value becomes non-linear. Rick Rule explains it with a very simple example. Imagine a silver producer. Let's say it costs them $20 to produce an ounce of silver. If the silver price is $40, they are making a $20 margin. Now imagine the silver price doubles from $40 to $80. The price of the commodity has increased by 100%. But look at the miner's margin. Their cost is still $20, but now they are selling for $80. Their margin has gone from $20 to $60. The commodity price doubled, but the miner's profit margin tripled. In some scenarios, it quadruples. This is the leverage. And right now, the market is not pricing this in. Rule notes that Bay Street and Wall Street research reports are currently assuming a $45 silver price when they look at earnings. They are calculating the value of these companies based on a conservative, arguably unrealistic forecast. If a company is making silver for $75 and delivering it into a forecast of $45, you aren't going to see an earnings surprise. But if the real-world price holds at $75 or $80, the net present values that analysts have ascribed to those producers are unrealistically low. The valuations of silver stocks today are discounting lower silver prices. If today's silver price just holds, it doesn't even need to go up, it just needs to not crash. The miners are vastly undervalued. We are looking at potential earnings surprises that could shock the market. So, for a speculator like Rick Rule, the choice was clear. The silver equities are a better receptacle for speculative capital than the metal itself. Silver just needs to maintain today's price for the equities to win. For physical silver to win, the price has to keep climbing. Now we need to talk about specific examples. It is not enough to just buy an ETF and hope for the best. You have to be selective. As Rule colourfully puts it, he is interested in the silver miners, not the silver morons. There are plenty of companies out there that have the word silver in their name or on their share certificate, but they don't actually have any silver. If the price of something you don't possess goes up, it shouldn't impact your value. That's common sense, but common sense is often rare in a bull market. One of the companies that illustrates the deep value opportunity in this sector is Pan American Silver. Rick Rule owns Pan American not just because of its current earnings leverage, but because of a different kind of leverage that the market has completely ignored. Pan American holds two massive undeveloped silver deposits, one in Guatemala and one in Argentina. These are each 500 million ounce high-grade deposits. Let that sink in, 500 million ounces each. Yet these assets are currently figured into the company's net present value at zero. They are valued at nothing. Why? Because of political constraints. In the past, the governments in Guatemala and Argentina have blocked development due to domestic politics. They essentially tried to take too much of the pie, trying to take 35 to 50% of the economic value of the deposit after capital payback. At $20 silver, the economic benefit to the state wasn't enough to override the political cost of approving the mine. But we are not in a $20 silver world anymore. We are potentially in an $80 world. At these prices, the tax revenue and economic benefits to Guatemala and Argentina are in the billions. Rick Rule believes that neither government can afford to leave these deposits unbuilt. The avoided revenue is simply too high for these cash-strapped nations to ignore. He believes there is a high probability that a political accord will be found. If that happens, those assets move from passive status on the balance sheet to active status. And right now, as a shareholder, you get the option value on those two massive deposits for free. Free, as Rule says, is a very good price. This is what we call redundant assets. Assets that don't contribute to current cash flow, but have massive residual value. The market hates uncertainty, so it values them at zero. The speculator loves uncertainty because it provides the opportunity to buy $1 for 10 cents. Let's move to another major player, Wheaton Precious Metals. Now, Wheaton is technically a streaming company, not a traditional miner, but it is a powerhouse. The market assumes that the glory days of big streaming deals are over, that the big deals have already been done. Rule believes this is exactly wrong. He believes the biggest deals are still ahead of us. To understand why, we have to look at the copper market. The copper industry is facing a massive supply deficit. In London, industry experts have suggested that miners need to invest $250 billion over the next 10 years just to maintain current production levels. Meanwhile, demand is compounding at 2.5% per year. The problem is, the copper industry does not have $250 billion. They are short on cash. Inflation is raising the cost of building mines every single month. So how do they fund these massive projects? This is where silver comes in. Many large copper deposits produce silver as a byproduct. To a copper miner, that silver is just icing on the cake. But here is the arbitrage. Silver streams trade at a much higher multiple than copper earnings. A silver stream might trade at a 15 times multiple, while copper earnings trade at 6. So, if a copper company sells its future silver production to a company like Wheaton, they are essentially taking revenue that the market values at a 6 and selling it for a 15. It is instant value creation. It allows them to raise billions of dollars to build their copper mines without diluting their shareholders. Rule predicts that we will see very large copper deposits financing their construction by selling silver streams in billion-dollar and $2 billion chunks. And there are very few companies with the capacity to write a check that big. Wheaton Precious Metals is one of them. Furthermore, we are entering a cycle of mergers and acquisitions. If a giant mining house like Rio Tinto wants to acquire another company, it might finance part of that acquisition by selling a silver stream on the acquired assets. It is a way to raise cash quickly and efficiently. So, Wheaton is positioned to be the banker for the entire base metals industry. The market hasn't fully priced this in yet. They see a streaming company. Rule sees a capital deployment machine entering a remarkably fertile environment. I want to pause here and remind you that this kind of analysis, looking at the geopolitical triggers in Guatemala or the arbitrage between copper and silver multiples, is what separates the winners from the losers in this market. If you are enjoying this deep dive, please take a moment to subscribe to the channel. And more importantly, click that link in the description to join our Telegram channel. We post updates there that are too time sensitive for YouTube. Now, let's zoom out and look at the macro picture. Why is all of this happening now? Rick Rule points to the history of the 1970s. He has lived through this before. In that decade, the US dollar lost 75% of its purchasing power. Not coincidentally, the gold price rose from $35 to $850. We are seeing a correlation between the deterioration of the purchasing power of the US dollar, real interest rates, and the reaction of precious metals prices. Rule suspects that in the next 10 years, we will see another 75% deterioration in the purchasing power of the US dollar. This is the wind in the sails of the bull market. But, and this is a huge but, you must be prepared for volatility. The Rule guarantees volatility. He predicts that in the next 10 years, we will experience at least one, probably two, declines in the gold price of 30 to 35%. In the 1970s, they experienced 3 such declines. Let me tell you a story from that era that Rule shares. Between 1970 and 1975, the gold price increased 6-fold, from $35 to $200. Everyone fell in love with it. The price action justified the narrative. People who didn't care about gold at $35 were suddenly obsessed with it at $200. Then, in 1975, Congress and the Fed raised interest rates. The gold price fell by half. It crashed from $200 to $100. The same people who loved it at $200 absolutely hated it at $100. They got shaken out. They sold. They wished they had never learned how to spell gold. And right after they were shaken out, the price ran from $100 to $850. This is the danger of narrative love. The people who are most uniform in their love of a narrative are often the first to be shaken out when the price action turns against them. The market is designed to test your conviction. The rule is, staying in this trade until the fundamental reasons underlying it go away. He is not swayed by the daily fluctuations. He is looking at the purchasing power of the currency, and he sees a one-way street downwards. This brings us to the psychology of the speculator. This is perhaps the most important part of today's script. You can have the best analysis in the world, but if you don't have the stomach for the trade, you will lose. Rick Rule is a contrarian. He looks for hate. When he announced on social media that he had sold 80% of his physical silver, the response was filled with vitriol. People were angry. They called him names. And for Rule, That was the confirmation he needed. He says, "When X is widely lined up against me, I know I'm correct." He saw the same thing 10 years ago with uranium. He proposed investing in uranium when the sector was dead, post-Fukushima. People were apoplectic. They said it was a failed bull market. 5 years later, when he sold, they called him a half-wit for stepping out of a bull market. The crowd is almost always wrong at the turning points. When you see 25 out of 30 comments violently opposing a move, that is often the signal that you are doing precisely the right thing. Many speculators simply do not know how to question themselves. They fall in love with the asset. They make the asset part of their identity. But an asset is just a tool. For Rule, silver was a speculative asset class, not a religion. He bought it because it was hated. That reason went away. So he sold it. He found another asset class, the miners, that fit the undervalued criteria better. So he shifted to it. This requires discipline. It requires the ability to write yourself a memo, literally a 1 or 2 page memo, every time you make an investment. Write down why you made it. Write down the liquidation value. Write down the risks. Write down what would cause you to sell it. If you can't articulate that, you are not speculating. You are gambling. Currently, the silver equities are discounting $40 or $45 silver. But if we are in a $75 or $80 environment, the stocks have to play catch-up. That is the beta trade. Rule prefers the probability of a triple to the possibility of a 10-bagger. He wants the math on his side. He is betting on the increase in margins. He is betting on the net present value calculations being rerun at higher commodity prices. The difference between a mine plan calculated at $30 and one calculated at $80 is stark. It is dramatic. So what is the takeaway for us? What changes? The silver market has changed. It has matured. The easy phase of simply buying the metal and waiting for it to go up is likely behind us. Or at least, it is no longer the most efficient use of capital. The reward-to-risk ratio has shifted to equities. The miners are the new hate trade. They have lagged. They are undervalued. They are ignored. We have Pan American Silver offering free optionality on massive geopolitical assets. We have Wheaton Precious Metals poised to finance the global copper deficit. We have a sector that is priced for a pessimistic future, while the commodity itself is signaling an optimistic one. This is the time for preparation, patience, and discipline. It is not the time for emotion. If you are holding physical silver, I am not telling you to sell it all tomorrow. Rick Rule is a sophisticated, wealthy speculator who treats gold as his insurance. His silver was for speculation. You must decide what role silver plays in your portfolio. But if you are looking for growth, if you are looking for that outperformance in 2026, you need to look where the crowd isn't. You need to look at the producers who are about to see their margins quadruple while the market pretends nothing has changed. The dollar is declining. Real interest rates are problematic. The debt is expanding. The macro table is set. The only question is, are you seated at the right table? Physical metal provides insurance. Mining equities provide leverage. As this bull market matures, capital will migrate toward the segment offering the greatest marginal return per unit of risk. Right now, that migration points directly to the miners. I want to thank you for watching this deep dive. If this script helped clarify the complex dynamics of the silver market for you, please like this video. It helps the algorithm share this message with more people who need to hear it. And please, do not forget to join our Telegram channel. The link is in the description. We are building a community of disciplined speculators, and we would love to have you there. My name is May, this is What Changes, and I will see you in the next video.